Good morning. I'm Vince Lancy. Today's market rundown, we will be discussing China loosening up potentially and how that would affect gold, silver, and copper, or how it has already affected it, as well as oil. And we have a couple other things to discuss. In premium, we have Blackrock's weekly report, which is very good, whether you like the firm or not. Let's start with the markets. 10-year yields are 423, up almost 3 basis points. The dollar is 106.35, up 18. The S&P 500 is 60.60, up 8. VIX is 14.11, down 7. Gold is 26.76, up on the highs, up 16 and change. Silver is 31.86, up 5. Copper is 419.5, down 2. You could argue, as I have in the past, that those two commodities are being sold against gold, and I would say that that's happening. But you can also just make the case that industrial commodities are softer today while gold catches up. So gold is the exception today. And you'll see that as I go through the rest of the commodities. WTI is unchanged. It was lower. Natural gas is down 9. Bitcoin is down 417. Ethereum is down 29. Platinum and palladium, okay, well, they're up. Palladium is 974, up 16. Platinum is 940, up 9. And gold silver ratio is slightly stronger. The dollar is stronger, and gold's bucking the trend on the dollar. Other industrial commodities are weaker. Copper is down, oil is down, and oil's basically unchanged. And silver is, again, straddling that area between industrial and precious, which is why it's the Goldilocks metal. Anyway, grains, soy 993, up 3 cents. Corn, unchanged at 428, and wheat is 557, down almost 3 cents, 557.5, I should say. All right. Front page, making sense of Syria. That's what we started the day with yesterday, saying, okay, this is probably why gold and silver and copper were stronger, although we did note that silver and copper shouldn't have been that much stronger. And then the answer came right after we got off the broadcast, and that was China's news from the night, which we're going to go through right now. El Salvador's gold reserves up 3 trillion. We have that story. That's reportedly from them. And why did gold and silver wake up? We're going to do that right now. The discussion itself, okay? Discussion, yesterday's PM Gold Fix we sent to subscribers had the post in it. And it had a market recap, which we will do when there's a significant move or some significant possibly event or driver worth bringing up when there is a move. And so in that discussion, today's discussion is based on that. And we're going to go through Syria's collapse, China's Politburo decision, PBOC buying returns, and participant position. These are all reasons. The first 3 are reasons or catalysts for gold and silver's rally yesterday. Participant positioning is how the table was set leading into the news events. So let's go through that right now. Starting with Syria. Syria's collapse was grabbing headlines, and the market's response have been predictable for the most part. Gold and oil were up as traders sought safety and price and potential disruptions of supply. Platinum, palladium, indirectly tied to Russia, also moved higher. What was less predictable, and we noted it yesterday, was silver's outperformance and copper's strong move. Historically, in geopolitical terms, gold leads and silver follows. That's not what we're seeing here. That's not what we saw yesterday. Instead, silver's gains outpaced gold and copper. Copper was kind of joining the rally. This suggested to us back then that there was more driving the market than just Syria, and lo and behold, entered China. Yesterday, China's Politburo signaled a move toward a moderately, quote, moderately loose, end quote, monetary stance. Now, according to Goldman Sachs, this kind of language is rare and typically precedes fiscal stimulus. So it's a monetary comment as well as a fiscal comment, but it's not an action. It's a chat. It's a note. The last time we saw this, and this is interesting, was during 2008, 2010 financial crisis. Back then, coordinated global stimulus by the US, China, and Europe created a tsunami of liquidity. And there you have it. That's a Bloomberg graphic. And hat tip to the market ear for pointing that out. As you can see, they make these announcements of what their vibe is, 2011 to 2024, prudent, whatever prudent means, right? But November 2008, 2010, moderately loose. That terminology is like saying responsibly loose. And the last time they said that, that was the global financial crisis, and big stimulus followed. Now, they're already in the process of adding stimulus, so maybe there's going to be more. And markets all reacted to that. They went, okay, the last time they said this, that happened. They're in the process of doing this, so more of that could happen, and that's why markets moved. China stocks also did very well. So according to Goldman, well, they had a specific take, right? And they were parsing the words because it's in Chinese, right? China is focusing on domestic demand, stabilizing its property and stock markets, and preparing for, and here's where the phrasing comes in, quote, unconventional, counter-cyclical policy adjustments. So when you hear the word counter-cyclical, that's a fancy way of saying that they're ready to inject serious money into their economy, which is opposite of what you'd expect right now, counter-cyclically. So they're boosting, right? Other phrases were noted like forward-looking, targeted and effective, more proactive fiscal policy, and moderately loose monetary policy. So for China stocks, that is very good, especially since they're targeting China stocks now. They're trying to make their economy more financial. They need to grow their payment chains, and financial is payment chains, and they need to lever up. They're having a hard time getting their people to do that. For commodities, it is also very good. So monetary easing supports gold. Fiscal stimulus, if it follows, will drive demand for silver and copper at the fundamental level. They already have demand. Silver, copper, I'm not so sure anymore. That partly explains why silver and copper were outperforming as well. Thus, the rally was not, for the most part, war-related, as I initially opined. The next question is, how is the market positioned for this? Well, very well. Reuters reported, and we posted here, that China's central bank resumed buying gold for its reserves in November after a 6-month pause. Official data by the PBOC showed this on Saturday. That's a Bloomberg chart. You can see the slope is upwardly ticking now. Now, it's not a very big upwardly ticking slope in comparison to what they've done in the past. So assume that they're buying, but they're buying less. For now, until they buy more. We have no idea what they're really doing. Now, staying with the positioning, funds, speculative, and we're staying on the American side now. Speculative American funds are underweight. Now, you may not be able to see that on this picture, but you'll see it in the post. That's a CTA analysis, and what it shows is that while funds are long gold, they're very underweighted long gold, and they actually are short oil, short copper, and short silver, although that's not short. They're barely short silver. But the point is, their normal behavior is to be longer gold than they are and less short copper than they are. But you can see from looking at this, when you think about the things I say about gold and silver, you can see that certain types of funds will buy gold and sell copper. They'll buy gold and sell silver. It happens all the time. It's been going on for decades. Next thing, this is exclusive, right? On Sunday, we revealed that bullion banks, which had been swap dealing desks, let's put it that way, not necessarily bullion banks, but those firms which make markets for the other players in the space, had been handcuffed for the last 2 to 3 months on what would essentially be called a liquidation-only diet. And post the election, last Commitment of Traders report was the first week where we saw them participate again. Let me see if I can make this one bigger for you all. But it's kind of a cool little chart there. All right, this is your CFTC report. Now, on the left in the green, shows the producers buying. And in the middle, in the red, shows the swap dealers or market makers selling. Now, swap dealers and market makers hadn't sold for a long time in that kind of size. And it was after the election, so you could see how maybe they were having the reins loosened on their behavior. What was strange was producers buying. That doesn't happen. Producers don't buy, producers sell. They sell and they let it go off and they roll. Now, there are other things going on here, but the fact that they bought in a sideways market is strange from my experience. And we noted that very pointedly in the Sunday conversation. And it turned out that, well, producers knew something the swap dealers didn't for a change. Next, open interest. This is from Randall Blava, a GoldFix founder. The swap, let me shrink this a little bit so we can see it all. The swap dealers selling and the producers buying was also coincided with a bottoming in open interest. Now, this graphic may be a little bit busy for you, but the gold line is the price of gold and the red and blue lines are the open interest. And what you'll see is that what we're trying to draw your attention to here, there are many things in this chart to see. What we're trying to draw your attention to here is that every time the speculators get out, you see a blue rectangle at the bottom, right? That's when them getting out. But every time they get out, the market is stopping at a higher level. So every time they exit, the floor is being raised, which is something we said over 2 years ago and many times since then. The floor for gold is being raised for silver as well. What does that mean? That means that the speculators, which drive market prices up $100 and down $100, now only drive the market up $100 and down 50. Why? Because someone keeps catching the selling. And that's your central banks, and that's your BRICS, and that's your macro discretionary funds. That's what's going on in this market. And the change is official. The question is, will it continue? And you always have to ask yourself that. You're looking at a Blackrock graphic there. It has nothing to do with precious metals, but I just leave that up there while I'm saying that. We also noted for subscribers, volatility is cheap and clean, but not free this time of year. So cheap meaning it is, I don't have the chart handy. Cheap meaning it is relatively cheap to where the price is. If you wanted to speculate on a long side, not on a bear side with options, on a long side, you would be a buyer of calls or a buyer of call spreads. Clean, meaning there's not a lot of open interest to get in the way. There's not a lot of crowded people in the trade right now, but not free because we are entering into the holiday season. And so cheap volatility can remain cheap this time of year as traders like myself and banks will start to run their clocks ahead and say, well, a week from now, the market will be, I'll be back at work a week from now. And so they'll start preempting by selling options ahead of time. And there's the Blackrock weekly commentary. Let's go to the back to the screen. All right, so that's what happened yesterday. You're seeing a continuation of that in fits and starts today. And we'll talk about the actual markets in a second. News and analysis. Why did gold and silver wake up? We just discussed that. Making sense of Syria. El Salvador's gold reserves worth up to $3 trillion. President Bukele highlights economic potential. We have that story hosted here as well. Quick comment about that. He's referring to on the surface of it. He's referring to something called the Pacific Ring of Fire. There's a lot of volcanoes that goes from the Pacific coast on both sides. The rim. It's almost like there are tectonic plates there, and so you have volcanoes there, and that happens to be where we have made a lot of gold findings. So Alaska, California, you go to South America, that's one side of the Pacific tectonic plates. And so that's a valid statement. How much is there? I think just to give you some perspective, there may be $3 trillion in gold there, but it's not under, I don't believe, I could be wrong, that it's under El Salvador. I believe, whether it's true or not about his verification of the gold available, that the president's statement was geared to be a counter statement to the Google comment about them having quantum computing. And also there is a Bitcoin push now around of what they would call FUD. basically Saylor, let's sell all the gold again and buy all the Bitcoin with it, right? Bukele acting the same way. So there's a push to demonize gold and take market share from it, just like there was in 22, or was it 21? I'm not sure. 22, when you saw the advertisements on CNBC, sell gold, buy Bitcoin. And that's going to happen. What you should keep in mind if you're a Bitcoin hater and a gold lover, to keep your bias in check, is that if they're doing it and getting away with it while BlackRock is buying Bitcoin, and they are buying a ton of Bitcoin, well, then the government's okay with that. So ask yourself what's going on there, and be aware that there's risk involved all the way. CPI prep, inflation is getting entrenched. It's not legitimately a prep, but what it is there's a very interesting comment made by a macro analyst that we shared with premium subscribers, that inflation is getting entrenched. Now, it's the second time he said this, but he said it in a way that really resonated with us. And inflation is getting entrenched because price increases are getting entrenched. Remember, we talked about, or Powell was so concerned about wage price spiral. Prices go up, wages go up, prices go up, wages go up. Well, prices are going up and companies are getting comfortable raising prices, but no one's really pushing back, especially now they have a Republican president. There's no Democrats saying price gouging. That you probably won't see that coming out of a Republican president. And while that's happening, wages are not going up because we have the increased influx of immigrants and low wage labor. So inflation is getting entrenched. In simple terms, we're not bottoming at 2%. We're not going below 2%. According to the data, we're bottoming at 2.5% to 3%. And that's just the way it is. Russell Napier, China's rise ends the post-Bretton Woods era. Very long read, but if you're familiar with his work, it's a very good read. The message there is that after Bretton's, this, as a gold person, you probably will be like, yeah, right. You're going to want to read this. After we broke the Bretton Woods era, right, post-1971, there really was no plan. There was no meeting. There was no replacement system. There was just wing it with the dollar. And because there was no plan, Napier notes that, when China did what they did in 94 and 98, they basically started another monetary system. So there's two competing monetary systems, and as the Chinese monetary system grows, it becomes more incompatible with our way of thinking. In English, well, gold and real money versus fiat money, those are incompatible. And so Cold War 2.0 is a monetary Cold War. And then the master class, that's a 2-hour class there, not for everyone, but it goes through everything about the CFTC report, and I was even more long-winded than normal. So if you like that sort of thing, you're going to like that a lot. Equity recap: U.S. equities declined on Monday ahead of the consumer inflation report on Wednesday. Market news: there's El Salvador's gold reserves. You can read that. China's leaders on Monday. This is, again, the story that we just described. China's leaders on Monday pledged more proactive fiscal measures and moderately looser monetary policy. CNBC doesn't listen to us, but they read the same things we read. And the fact that we're talking about this now and people like us talk about this now is why the mainstream media is doing their job once in a while. Breaking Bitcoin, that's our phrase. Google on Monday said it has overcome a key challenge in quantum computing with a new generation of chip, solving a computing problem in 5 minutes that would take a classical computer more time than the history of the universe. It's called Willow. Read it. Not necessarily because you believe it works, not necessarily because you believe it'll break Bitcoin, but it's kind of mind-opening when you think about the computing being compressed like that. It's like a time warp almost. Anyway, whether it's something that can break Bitcoin or not is debated. Quantum computing cracks codes. Bitcoin can have a quantum defense, yada, yada, yada. I don't care about that stuff in terms of Bitcoin. I care about the fact that BlackRock and MicroStrategy own so much of it. We'll talk about that another time. Magnificent Seven tech giants, China's antitrust regulator, whatever. Data on deck. Wednesday, tomorrow is CPI, and Thursday is PPI. Today is U.S. productivity revised. There's BlackRock's weekly commentary. Again, we like their work. Otherwise, we wouldn't share it. Let's take a look at the market. So we've got gold and silver up there. Great, gold's on the left, and we are now above the. Oh, very pretty. Let's do this. All right. So now stretch this a little bit. All right. So now gold is above the 50-day. So if you're looking to be bullish, you should be bullish. And you should be less concerned with this, because now we're in the above the 50-day moving average for both, right? Silver can be weak, and you're like, should I not own silver now? Well, maybe you should own gold right now. Maybe you should roll out of your silver into gold if you're speculating. But for the next thing for me, and this is all very micro stuff. This isn't macro stuff. Very micro stuff is I want to see the 50-day moving average uptick, and you can pretty much simulate how that happens. I think the most important takeaway for silver as well as gold is, starting with silver, is Michael Oliver's momentum levels. We're above his area now. So tomorrow is an important day. If we don't make a new weekly low tomorrow, I'll make a statement. If we don't make a weekly low tomorrow, we will probably make a weekly high on Friday. Can't believe I just said that, but that's the logic that goes through this. So looking at silver, above the 50-day moving average. Look, here's your ledge, right? There was real selling here. Boom, right? Probably profits. And then that selling came back again, but this selling is not that selling. Trust me on that. So if we get, they're probably retrenched to here. If we get up to here, 32.60, a run to 34 would not be a problem. And then you run into whatever the heck was going on here, right? This is short covering. And again, there's physical demand for silver as well, the FP. Gold is, gold's a story today, but if you look at gold, it's doing what it's supposed to do. It's research. I'm really surprised when the market did this and then it did that. I was surprised, waiting for the hangover post-election to last longer. And then this happened. I said, okay, we're going down again. Or I said, we're going to be in this range for a while. But now we're above it. I'm like, wow, this is crazy. So my prognosis is sideways for a month or two. So we can all get excited about this, and it is exciting. But, until we're above here, you're not crazy bullish. We're still pretty much in a range. That's it. Have a great day.